everybody. Thank you ever so much for joining us today. We're going to talk about preparing your business for sale and succession planning in general. And I'm delighted to have with me today my colleague from Knights PLC and from Wilson Wright, who will talk about tax, and Knights will talk about the legal aspect. Myself and Cunning, who is my managing director, will talk about valuations and the whole processes of selling your business. So if we could have the next slide, please, that would be great. This is a little bit of a summary about us all. At FDS, we are a corporate finance boutique. We have been in business for the last 30 years, as you can see by our little logo. I'll let the guys from Wilson Wright and Knights introduce themselves when it comes to their slot. So if we could have the next slide, please. So I am Jo Haig and I'm the CEO. I formed the business some 30 odd years ago, and over the last 3 decades we've been involved in over 400 transactions. Mostly those have been with owner managed businesses where we think our expertise resides, and we always say, well, we are an owner managed business, so if we can't help owner managers sell that sort of business when we are one, then it wouldn't be a very good business to have. So we understand what it feels like to be an owner manager. In terms of deal size, well, the biggest deal we've ever done was $72 million, but by and large, our deal sizes tend to be rather more modest than that. Big owner managers, 10 to 20 million would be at the top side of our deal. We do all sorts of things. We do buyouts, we do buy-ins, we do raising finance. We help people transfer their money, their business essentially, to another generation or another owner. So if you go on the slide, first of all, I just wanted to say to you that, a bit like having a baby, getting married, there's never a right time to do this, but it's always better if you've got some sort of plan in ahead. And it's why do you need a plan? What's going to trigger this requirement to sell your organization, which can sometimes, and I know this personally from an owner manager's point of view, feel like your baby. You've grown up with it. You've taken it through all the teething stages, through adolescence, all the way to being a mature adult. And why are you wanting to sell? There's a million and one reasons. Perhaps you're just tired, perhaps you just want to do something else beyond the boardroom. It might actually be another business that you want to do. Maybe you're actually bored with what you're doing now. And, after several decades, business changes, the people change, perhaps you want to do something entirely different. Of course, it could be something a little bit more draconian. And just like a marriage, you do sometimes fall out with your spouse, and the same thing happens with shareholders and directors. And one of the other things we certainly do, is sadly we have to work on shareholder disputes. So plan for the worst, and hope for the best is something that I would say that you might want to consider in those circumstances. And without a doubt, it's true that sometimes our businesses outgrow our own ability or potentially our own resources. As an owner manager, I've certainly given personal guarantees. I've risked everything, including the family silver. But there does become a point, particularly when you get to a certain age, where you think, I'm not prepared to do that anymore. And of course, sometimes the business itself has outgrown your personal skill set. I remember selling one business. It was an absolutely amazing business that this lady had started in her back bedroom. If I tell you, ladies and gentlemen, it was turning over £1 million, but making 750,000 net profit. Just a fabulous business. But it was growing so quickly that actually this lady started to get really scared that it wasn't her skill set. And this business that she built in her back bedroom now needed much more sophisticated management processes and people and spend and so on. And she just didn't want to do it. So those are some of the reasons why you need to think about what can happen. Okay, if we go on to our next slide. I've called this a cunning plan. And for those of you that have watched Blackadder over the years, a cunning plan is something that we should all have at the back of our mind. And there's all sorts of stuff going on. Without a doubt, the last 2 years have been a shock to simply everybody in the world as to what's going on in their life and in their business. And of course, our Chancellor has thrown gazillions of pounds at the economy to keep it going. So I anticipate, like a lot of people in my profession, that there is definitely going to be some land grabbing, if you like, and there's no doubt that CGT is on his list. So at the moment where you can get 10% tax payment on the first £1 million of the capital gains, and after that it's at 20%, the worst that could happen here is that he will align CGT to income tax, and perhaps this is something that Emma from Wilson Wright might like to refer to later on. I guess the best is to put everything at 20%, but he's got to get back this money from somewhere. So I would say watch this space. The other thing to tell you is a little bit like selling your home. This process can be quick, but it's much more likely to be a longer term process. And we would say to you that from the day of instruction, you're saying, right, Joe, sell me my business, I want to sail off into the sunset, then you should be thinking about a 12-month period. I probably should warn you, though, that 12 months in the corporate finance calendar is probably 14 months of everybody else's calendar, because prior to the pandemic, August and December really didn't count as months. And we were just having our own away day yesterday and looking at how we'd done last year. And actually, we had an amazingly busy August and July. And that was probably because nobody had gone on holiday. But by and large, those are very quiet periods. I'd also say to you that if you think it's tough doing your job now, and I'm sure it is, we're all at a very tough time, you are going to have to be extremely resilient to go through a sale. So, you know, we don't paint pretty pictures about this. It's a real journey, and you need to build up a team to support you. And I don't just mean a business team. Of course, you need to get the best advisors you can. You must keep running the business, but you need to build up a team of personal support, because it's a roller coaster like no others. And whilst your advisors will do their very best to take the brunt of everything that's thrown at you, at the end of the day, there's a lot of information that we simply don't have, that we have to extract from you and give to the prospective buyers. Well, as the pandemic started, and none of us knew it would go on for the period it has, and I think I'm not alone in saying this is something we're going to have to live with probably for a very long time. All our crystal balls have at best clouded over, and a lot of them are frankly broken. I will tell you that there is an awful lot of money floating around out there, because deals haven't been done in the same volume. And Poonam, my colleague, will be picking up with you about business valuations, but there is a publication called the Private Company Price Index that tracks deal multiples. And I was talking to my colleague yesterday at it, and those deal multiples are in double digits. And that is because there is a lot of money chasing deals. Now, that isn't to say that I want you to ring up immediately and instruct me to sell your business. Well, actually, I'd love you to do that. But what I don't want you to think is that I'm going to get 10 times and plus multiples, because it really depends on the sector. We would, however, be very happy to talk to you about your sector and the desirability of that at the moment. And as we're going along here, I should just mention, if anybody's got any questions, put them in the chat box and we'll answer them as we go along, or please, we'll have some time at the end to answer any questions. So if we could go on to the next slide, please. Of course, there are many different ways of exiting a business. The most common and probably the most lucrative is a trade sale. So that trade sale could be to a horizontal business, in other words, a business in your same sector, but of course it could also be to a vertical. So it might be to a customer or a supplier. And of course, when we think trade, do not just think UK shores. There's lots of opportunity for international transactions. Without a doubt, this gives the most value, because very often these organisations will be able to bring synergies to the table that other types of exits don't bring. Their due diligence is usually perhaps slightly different to the due diligence of private equity sales, which I'll just mention in a moment. And they're keen on looking at What are the management like? Are they going to be able to run the business going forward? Sometimes with a trade sale, there'll be earnouts and vendor loans support, depends on the nature of the buyer. And if any of you out there are thinking, oh, I wouldn't do a vendor loan or I wouldn't do an earnout, you are restricting your pool of possible buyers. Be open to everything for a debate. And one tip I would give you is, so I've got a little question coming there. Hi, Joe, do you specialise in, Poonam, could you just, questions gone from the chat box.
Yeah, it says, hi, Joe, do you specialise in the sale of businesses in any particular sector? If so, which ones? Additionally, which sectors are particularly hot in terms of deals?
Okay, thank you very much. So we're probably sector agnostic, and we were looking at the, of over 400 deals. We've probably touched virtually every industry that you can imagine. Our genre is owner-managed businesses. That's what we know. We understand the psyche of the vendors. We understand in terms of presenting that business that an owner-manager has run in the most appropriate way. In terms of what's hot, digital and healthcare, extremely hot properties at the moment. And those are quite wide areas. That isn't to say other areas are not interesting, but those are probably getting some of the hottest multiples at the moment. So the other kind of exit is private equity / venture capital sale. For these people to be interested, we're probably going to be talking about larger deals. So they're very, very unlikely to write a check for less than 5 million. And that would be a relatively small deal. In order to attract these sorts of people who actually their multiples are higher at the moment than trade deals because they have got a lot of pent up cash that they haven't spent, you need to have a management team to die for. And if you want to exit your business as part of an equity release, you need to make yourself the least most important person in that business. Otherwise, you'll find yourself tied in. It is a little bit like dancing with the devil. And we've done deals with these people, but it's a little bit like getting married. Choose your bride with care. Divorce is expensive and painful. Of course, you can sell it to the management. And we've got here something called a VIMBO, which stands for Vendor Initiated Management Buyout, and an MBO, which is Management Buyout. The end result is the same, and that is that your management take over ownership of the business. So with a VIMBO, it's a bit more of a collaborative style approach where we're working together. So you've only got one set of advisors. We're agreeing a price in a more sort of less combative sort of process. The major problem with MBOs and VIMBOs is the lack of finance that the management teams have. And by and large, such deals have to be geared up by using vendor support and as much debt that we can gear up on the business. So for most MBO deals, you're probably going to have to wait a little bit longer for your money than, say, a trade deal or a private equity deal. And the last area, which is something we are very experienced in, and I can say this personally because we are one, is what's called an EOT. And that is where you transfer your business to your staff. And the good news to the vendors out there in the audience is that you pay 0 capital gains tax on that consideration. There are certain rules that you have to comply with. We would be very happy to talk to anybody who would like to do this. As I say, we've done our own about 18 months, 2 years ago. And since then, we've done quite a number for other clients. It's a really interesting process and can be more beneficial than a management buyout, particularly because of the tax break for the vendor. Okay, so to the next slide, I thought I would just take you through the journey. So whoever you're selling to, and quite honestly, even if you're doing an EOP, you have to start with a valuation. I don't like to equate myself to an estate agent, but by and large, if you're going to put your house on the market, the first thing you want to know is how much it's worth. So we have to start with a valuation. And just to put this into context, ladies and gentlemen, a valuation is not what your business is worth. Exactly like a house, it might be worth more, it might be worth less. You might not sell it at all, but a valuation is a good place to start because we have a technical way of valuing businesses, which buyers will use. So at least you're comparing an apple with an apple. The important part of getting the most worth is to find a buyer that wants to buy what we call your hidden assets. Tax advice, and I know Emma's going to pick up on this, is also sadly too often left until too late. It's important to take tax advice, but it depends. What are you selling? Are you selling a division of a business? Are you selling a separate subsidiary? Are you selling the whole lot? Do you want to take property out of the business? And so sometimes there is some pre-preparation needed before you actually go to market. Next is finding your buyers. And there's all sorts of issues that vendors have about, oh, the word's going to get out, people are going to know I'm going to be selling my business, then I'm going to lose my staff, and then what's going to happen to customers and so on. So the word targeted there has been used on purpose, because what we're not going to do is a machine gun approach to hundreds and hundreds and hundreds of people. We're going to do a very careful look at the market, who is likely to buy, and most importantly, have they got the funds to do it? And in order to get to those people, of course, you need to produce a document. Back to me as an estate agent, then, it's like the things on Rightmove with the pictures of the rooms and the diagram of the building and so on. It's just telling you enough to make you want to know a bit more and perhaps go and visit that property. That's sent out, and then on the back of ascertaining interest, and that's all done by telephoning people up. We don't just wait for people to come back to us. We'll send out a non-disclosure agreement, and then you send out the information memorandum, which is sort of the story of where the business can go to as much as where it's been. What can you do with this business? And my little analogy is we're telling them about the smell and taste and sizzle of the sausage, not describing the sausage itself. And in order to engage people actively in any debate, any buyer will want to meet the management. Now, obviously, this doesn't apply to an MBO or to an EOP, but it does apply to trade sales, and it definitely applies to private equity. And that's bringing alive the cold information that we sent. We then run what's called a controlled auction, which is where we're asking people to make a bid, but it's never just a number. I will tell you, ladies and gentlemen, deals don't fail because of headline prices. They fail because of terms. So we ask them to provide us with an indication of what they would pay, how they would pay it, over what period it would be paid, and what are the broad terms of that. That eventually then, after an amount of negotiation and debate, goes into a document called Heads of Terms, which is the spirit of the deal. It's not the deal. Then we open the gates to all our secret cupboards, and we let that preferred buyer come in and do what we call due diligence, which is check the whole documents and processes that we've provided them. Then it's over to lawyers, and I will let Paul tell you about the legal process, but needless to say, that involves the preparation of the sale and purchase agreement, any shareholder agreements that are needed, any covenants, any property agreements, and so on, all the way to completion. Then you open your champagne and the real work starts for the buyers. So that's our process. And just one thing we say in our office is delays cause disaster. So we are extremely proactive at FDS at keeping deals going. Part of our job is project management. And I'm saying this knowing that Paul at Knights has worked with us extensively. We like to have a really good relationship with our lawyers and our advisors, our tax advisors and our accountants, to make sure everybody's doing what they should be doing when they said it should be done. And of course, you don't always sell to the person that you thought you were going to sell to. And over the years, Poonan and I have certainly had to go to the second and even the third buyer on the list because things have happened, sometimes completely out of everybody's control. So it's very important that we as your advisor keep everybody at that party happy until the job's done. Final couple of words. Whilst this is a hugely time-consuming process, and I've mentioned it can take up to a year, it's really important that you keep your business going. Do not take your eye off the ball. We say make decisions that you would be making as if you weren't selling the business. Obviously, consult with your advisors about the quantum of that, but not all deals complete. So plan for the worst and hope for the best, and get in place the best advisors that you can possibly find to help you through this journey to a new future. So thank you very much for that. I don't think we've got any more questions, but there will be plenty of time for questions at the end, or please do contact us. So I'd like to pass to my lovely Managing Director, Poonan, to talk to you about valuation. Thank you, Poonan.
Thank you, Jo. Hello, everybody. So I'm just going to talk about the importance of a valuation. As Jo's already mentioned, that, you know, a company valuation is not going to give us what your company is worth or what somebody is prepared to pay. What it does is it sets a benchmark for negotiations, because a lot of the buyers that will put forward bids will value the business using the same valuation models that are commonly used for SME businesses. I think the main thing that we have to always look at is that, you know, though we do a valuation, different types of buyers will have different views on the worth of that business depending on their own situation. So if it's a trade buyer, you're more likely to get a higher valuation from a trade buyer than you are from a private equity firm or a management buyout team as such, because having a trade buyer, there's a number of synergies that can be come from bringing that company into their own portfolio, and any cross-selling opportunities and complementary services that may complement the whole group. I think the other thing that I would just mention about when we're looking at company valuations is a majority of the transactions in the SME sector will be based on a weighted average of normalised EBITDA. For anybody who doesn't know what EBITDA stands for, it's earnings before interest, tax, depreciation and amortization. And you'll see on the slide we've got the red C. The red C is COVID. So at the moment, over these past 2 years, we are having to normalise the information for impacts of COVID, whether that's positive or negative, because any buyer will want to see, okay, how has COVID affected that business? And of course, the history is important, but it's the future that they're buying into, and they want to make sure that we have made adjustments that are COVID related. So when we're looking at a normalized EBITDA C, it is looking at stripping that back. So there's been examples when we've been looking at companies and they may have had a really bad 2 years, and we would, you know, in some cases treat them as like black swan years, ignore them and really look at the performance beforehand. Now we're at a stage with COVID where we know that we're overcoming things. We'll take into what the future performance of the business is, using the latest management information and looking at the pipeline of that business and ensuring that we can be as robust in our assessment. We also will, as part of our evaluations that we do, we look at real-time data in the sector that you may be performing in. So from that, we'll be able to ascertain what multiples are being achieved on that type of business for its size of business, for the sector that it operates in, and we'll look for comparable deal data. At the moment, and I know Jo referred to this earlier, that for us corporate financiers, we always look at the PCPI multiple, which is available publicly. And at the moment, the trade deals and the latest multiple that's been achieved is 10.6 times. That's based on an average deal size of 14.4 million. Now, for larger transactions, it is common to have a larger multiple, but we make those assessments and we will look for comparable data that fits your company and your sector. There's different ways of doing valuation models, and I've mentioned the weighted average and normalization of EBITDA, but there's certain industries and certain businesses that there'll be other methods that are more appropriate. So another method of valuation is net assets and plus goodwill. That kind of valuation model is more appropriate to businesses that have invested a lot in plant and machinery and assets. So that is where you've got a lot of money tied up in your assets of the business, and that would be more appropriate. Industry specific valuation models, they more apply to insurance brokers or accountants firm, where you've got recurring revenues year on year to a certain level. That's where industry specifics are more is the more appropriate method of valuation for those type of businesses. So depending on your business, we will look at different models and choose what the appropriate model would be, just so when we come to negotiation with buyers, we know where we have set the base and what we think the business is worth, and that helps with the negotiations that we undertake following the discussions that we would have with any prospective buyer. Next slide, Rach. So the next stage would be, really, when we're looking at valuations, we need to ensure that where are the golden nuggets of value. And I think Joe already mentioned that, whilst there is a method of looking at the financial numbers of the business and what the performance has been from the financial part of the business, there is always the aspects of that are not visible on a P&L and a balance sheet. So and what I'm referring to there is your management team, the quality of your customers and alike, because a profit and loss account and balance sheet will not show those hidden value of assets that you have in your business. To improve and increase the value of your business, there's a few nuggets here that are mentioned that you need to take into account, because these will all maximize your valuation of your business. So the first thing that we mention is having an engaged management team that doesn't include you. We want you to be the least reliant person the business needs. So if you've got a business, and we deal with owner managed businesses daily, we know how important owner managed businesses can be and how much involvement you may have in that business. But the best advice that we can give you is build a team around yourself that can run the day-to-day operations of the business, because any buyer will have that strategic vision and will have their team looking at that. It's just really the day-to-day operations. We need to take you away from that part of the business if we can. If you can secure any contracts with customers or generate any recurring incomes from customers, that also improves value, because there's that guarantee of income that's going to happen, and the longer the contracts, the better an increase in value you will have. Also, trying to make sure that there is no one key customer that represents more than 20% of your turnover. The more diverse customer base that you have, the more turnover is spread over across a number of customers, the better, because obviously if you lose one customer, any buyer will look at what will that do to your performance of the business. So it's making sure that you've got that customer diversification and the build-up of that customer base. Any cash generative business will maximize value. So if there's less requirement of working capital, that's great, and that always helps buyers to look at increasing value. Investment in R&D is always going to help in terms of improving value. Ensuring that there's that you've undertaken a pre-sale due diligence, ensuring that all your processes that you've set in place are all clear and you can demonstrate that. Again, that doesn't cause any delays. That all helps with increasing value. Having great management information systems in place increases value. I've mentioned already about the hidden assets, making sure that we've got a robust team, that you've got, you know, if you've got any blue chip customers, getting through the doors of those certain suppliers and having specialist supplier arrangements, they can all add value that are not visible on a profit and loss and balance sheet. Having a shareholders agreement in place can add value. At least that way there's mechanisms in place if there's any kind of shareholder dispute, that you've got procedures set already in the shareholders agreement to deal with that. And as I've mentioned before, we would always look at ensuring that we normalise your EBITDA for any hidden costs. And when we're talking about hidden costs, we're not just referring to COVID, but there may be costs that, you know, have been one-offs or discretionary spend that your business has taken, such as, you know, you may have had a large roof repair one year, you may choose to pay your golf subscription through the business. So we would normalise those figures to ensure that any buyer that were looking at this business, we would only include those costs that they would incur going forward, and really represent that in a way to give you that maximised value. I can see that we've had a couple of questions that have just dropped into the chat box. So it says, what about discounted cash flow as a method of valuation? Yes, definitely. That is another way of valuing your business. Of course, we would look at that if it's appropriate for your business to do so. So if your business is in early stages and it's looking for explicit growth in the next few years, discounted cash flow would be a method that would be used in those kind of scenarios. Thank you, Rachel. So that's on valuations. If anybody's got any other questions, please feed them through the chat box and we'll answer them as we go along. But I'll pass over to Emma, who will bring you up to date with all the tax.
Thanks, Poonam, and thanks, Joe, both for inviting me along this afternoon. It's a pleasure to speak to you all. It's a bit of a whistle-stop tour, I'm afraid, so I'll try and talk as quickly as possible to fit as much in. But if there's anything that you need some clarification on or want to talk to me about separately, obviously put it in the chat box, or I know that Joe will provide all our contact details at the end. So just a bit of background on who I am. I'm one of the tax partners at a chartered accountancy firm called Wright, based in London. Working on M&A matters for many years, and actually worked with Joe and Paul countless times as well. So it's nice to have the dream team on the call today. Rachel, if you can skip forward, we'll canter through. So the first thing that I would say to anybody that's looking to sell their business is make sure that you're getting the share capital table right. There's too many times that I enter a conversation and they say, oh, but I said to Bob, I'll make him good at the end, you know, for all the hard work that he did over the years. And it's very difficult to make sure that you kind of account for that at the 11th hour. So, you know, have a real look at who's got what shares, what share classes they are, what rights those shares have, and equally whether or not there's any other agreements that's going to bind how that consideration price is split between the people that you want to receive it. The other thing I hear a lot is I'll make them good afterwards. Don't worry, Emma, it won't form a part of the deal. I'll just, you know, bung them a bit of cash afterwards. And that's something that, you know, frankly, it's probably tax evasion rather than avoidance, and you might go to jail. So let's not do that. But there are ways that we might be able to structure it in a better way. So let's have that conversation kind of beforehand rather than kicking it to the side. The one thing to note, pre-completion bonuses are really easy to do, just standard goes through the payroll, but they're not ideal because the company doesn't get the usual corporation tax deduction that it would on a normal salary. And the reason for that is because, you know, you're not incurring that cost for the benefit or the furtherance of the trade in any way. It's all in connection to that share sale. So, you know, bonuses are the cleanest and easiest thing from a due diligence perspective, but not ideal from a tax point. And the other thing I think with regards to that share cap table is, you know, sometimes you'll have quite a lot of minor shareholders that have just been tagged along over the years. Perhaps you had an employee that you gave shares to, but they've now left the business, and just trying to tidy up the number of shareholders to make sure that really everybody is engaged in the process of selling the business, and equally, you know, would commit to the warranties alongside you. You know, warranties are structured usually as joint and several. And you want to make sure that everybody's kind of, you know, in it on the same terms. How do we get rid of people if we want to? Purchase of own shares is a really good way of using company money rather than personal money, and equally there can be some tax benefits of doing so, but also some pitfalls. For example, where somebody hasn't owned those shares for 5 years, it could be treated as income rather than capital, which not ideal. The other thing to bear in mind, if we're trying to buy out people that either are employees or were employees, then there could be an employment-related securities exposure. That's what the ERS stands for on the slide. And again, that's looking to kind of pull things back into that pay-as-you-earn net, which can be extremely costly. Rachel, if you can skip on for me. When looking at types of share proceeds, they can be taxed differently. So I just thought it was worth a refresher on that. Cash, everybody know and loves, you get it in your hand. The tax point is immediate, and you would pay the capital gains tax on that on the 31st of January following the end of tax year in which you received the money. Shares not so obvious. So if you have shares in your company and you're exchanging them for Bioco shares rather than kind of cashing out, as it were, then you are able to defer your CGT date until you sell those further Bioco shares, really being at the point at which you have cash in your hand to be able to pay the tax bill. That treatment is automatic, but some people like to go to HMRC for clearance in those situations because it offers everybody a bit of clarity. Certainly where we've got kind of some intense due diligence going on, it's nice to be able to tick the box and everybody get comfortable. But what the clearances is, they're only good as the application that's made. So please make sure they're on a full disclosure basis. Don't miss anything out to try and mitigate the chance of the revenue ever reneging on them. But the point that Joe made earlier here is a good one, in that you might not want to have that automatic share for share treatment. You might not want to defer your capital gains tax payment because you might be worried that the Chancellor is going to hike that capital gains tax rate up very soon. In which case we can look to accelerate the tax payment and disapply share for share treatment and tax it as if it were cash. The only thing that you need to be aware of is you're going to need to have some funds to be able to pay the CGT bill when it arises. Loan stock very much depend on how the loan is structured, and equally the tax implication that you're looking to try and achieve can influence that. So it's very much having a conversation with tax advisor and lawyer in terms of how that's structured, because we can look to either kind of tax it immediately or kick that gain down the line depending on whether or not it's a qualifying corporate bond or a non-qualifying corporate bond. And broadly speaking, as long as a loan can be denominated in another currency, it will qualify as non-corporate. So it's very easy to pick and determine that treatment between the two things. But it's a conversation that needs to be had. In addition, earnouts is something that in terms of share proceeds can offer real tax complexities, rather than kind of deferred payment, which just you kind of understand your amount or maybe not, but if it's unascertained. But usually there's a key performance indicator with an earnout. Something needs to be hit, and that will determine the amount that's paid. Now, we need to make sure that those milestones are connected to company performance rather than individual performance. Because individual performance will hark back to, okay, well, it's a payment in relation to services provided, which the revenue will want to tax to employment income. So we need to be mindful of that. You need to be mindful that all shareholders are treated the same. Sometimes when you have exiting shareholders and people that remain on in the business, once it's been bought, they're treated separately, and that can cause issues as well. Equally, if you want to try and separate those two payments between capital and income, you can say, well, look, I'm going to put a bonus plan in place over here so that I can reward this guy for his services separately, which makes that delineation between those two types of payments, and all those things are helpful. But earnouts are a particular complexity when it comes to M&A. So by no means be afraid to do them. You just need to make sure that you get the relevant advice in place and that everything's structured properly along the way. Rachel. The next thing, and I would say the biggest headache in any M&A transaction for me, is employment-related securities. As I mentioned when we were looking at the share cap table, understanding who got what and when and how much they paid, whether or not they signed something called a Section 431 election can be imperative, and whether or not they got those shares through an option scheme, whether that was approved like an EMI or unapproved. All of those things add to that pot, and what I would say to you very strongly is understand that fact pattern and get all of the information, the document relevant the relevant documentation in place and ready for that data room. If you can't explain well how somebody got something or why, it's going to leave big holes in due diligence, and the kind of the tax risk and implication on that could be quite significant. At the end of the day, if there are gaps and we need to quantify the amount of risk, then let's do that. But equally, if there are some things that we can do to address some concerns, if there are some filings that we can make to HMRC to plug the gaps, then we want to know and do that before due diligence commences. You don't want to be having that conversation after the fact. And equally, when the buyer has control of that communication with HMRC, because then, depending on the terms of conduct of claims in the SPA, you might not have any control or very little control as to what's included in that communication with HMRC. And I can guarantee when something goes wrong, the buyer co will just blame you. And you want to be in control of that communication to the revenue to make sure that everything is put forward in the best light, of course, to mitigate against interest and penalties. Rachel, thank you. Shareholder loans, stakeholder loans, directors, employees, relatives of employees and founders. I've seen them, and these are something that we want to make sure are all dealt with, really ideally either before or on completion. To be mindful here, if you just write that debt off, it can have some quite significant tax implications. So the person who you lent money to would be taxed as though it's a dividend. That rate goes up from April to 39.35%, so it can be quite damning. And there are better ways of handling it through cash consideration most of the time. We also want to make sure that, regardless of whether or not the amount's repaid, released, written off, the company will receive their Section 455 tax that they paid, at which the point the loan was granted. They'll get a repayment back for that. Now, a few things. You want to make sure that as the selling company, you definitely do get benefit for that. But equally, the buyer will quite often say, well, there'll be a timing difference between them getting it, the date of completion to them getting it back from HMRC. And we might need to give some assurances around, timings on that, because the buyer won't want to pay for something they haven't had benefit for yet. So it's a conversation to be had, but we'll get to a sensible place for everybody all around. And a really interesting one that people aren't necessarily aware of, where we've got family members of employees that have loans, and those are written off, for example, there can be some inheritance tax implications, which seems bizarre because we're talking about a company. When do companies pay inheritance tax? But these things can happen. So again, just be mindful that where any loans in the business, if they're not being repaid, nicely, then that we just need to make sure that we take the relevant tax advice to make sure that there aren't any completely adverse tax consequences that one might be naturally unaware of. Rachel, thank you. And lastly, what used to be called entrepreneurs relief is a known and loved phrase, then turned into business asset disposal relief, which is not only a bit of a mouthful, but stands for bad relief, which always and will continue to amuse me. The way that looks now is different to what it used to be a few years ago. So as Joe mentioned earlier, we only get that 10% on the first million now, 20% thereafter. And whether or not that remains is up for grabs, but they've reduced it down so significantly that, if they quash it entirely, it won't make that much difference. Still, 100 grand tax saving there to be had, so not to be quaffed at. It always used to be 12 months. That's up to 24 months now, has been in place for the last few years, and we need to make sure that the relevant conditions are met throughout that 24-month period. So not only we need a trading company, the person holding the shares needs to be an employee or officer, again, for the whole 24 months, and equally the 5% of all new share capital no longer just applies to voting or number of shares, but equally income and capital as well. The point I make there, please don't sign these away, and equally, please don't step down as a director, certainly before completion, because it's the moment that you do that, you break that 24-month period, and that now just needs to be done the previous 24 months, before completion. So if there's a difference between exchange complete, for example, and you need to step out and exchange, that will be a problem, because that period of time between exchange and complete, you won't meet the qualifying conditions, the whole thing falls over. People used to go for clearance on what used to be known as entrepreneurs relief if they, for example, had a trading company that had a bucket load of cash sat in the bank, because there was a thread of thought that meant that having that cash meant that you might not have a solely trading business. the revenue kind of threw that out many years ago and just said that, you know, advisors were just trying to write for clearance to get some fees rather than there being any ambiguity. So if you're going to approach the revenue for clearance on a business asset disposal relief claim, then it needs to be valid. Now, it can only be valid if there is some ambiguity and a risk of concern. And most of the time, it's not worth highlighting a risk of concern to the revenue. It's a red flag to a bull. So, you know, I think whether or not you approach clearance is something for serious discussion and debate. Please don't forget about things as simple as spousal exemptions. You know, these things can be put in place really simply. You know, shares can be transferred over to your spouse CGT free, and as long as we've got enough time, you know, 24 months prior, then we can make sure that we tick the boxes on all of those things with enough time due. Equally, if they already have the 5% and they already have been an employee for that time, we can give them more shares. You know, if they've got an individual situation where they're paying lower tax than you, then we might be able to spread some of that across and try and get it at lower rates. But it all down to the individuals. The point to note, tax point is when something becomes unconditional. So I mentioned the kind of split between exchange and complete, which, you know, sometimes happens, but you know, your tax point will be where it is unconditional. So if there is something that needs to happen between that period of exchange and complete, then you know, your tax point will move to the latter of those two. The other point to note, it's not an automatic claim. It's not an automatic tax saving or tax rate. You do need to claim it on your tax return, and the relevant disclosures need to be made accordingly. So please make sure that you take the relevant tax advice to make sure that claim is solid. The other thing I would mention here, I've known the revenue, certainly over the last few years, challenge pretty much every entrepreneur's relief and business asset disposal relief claim that's been made. They really do pay attention to it closely. So I would say, you know, for that reason and many others, please do make sure that you get the right advice so that the I's are dotted, the T's are crossed, and if ever challenged, you know, you can defend your claim vigorously and without any alteration. And I think that's all I've got. So I'm going to hand over to Paul for the legal section. Thank you, Paul.
Thanks, Emma. And thank you to all the hardy souls who are still with us and are prepared to listen to a lawyer speak for about 15 minutes on the finer points of the legal issues when selling a business. I applaud your enthusiasm. Thank you, Rachel. So just a little bit about Knights. I think Joe already introduced us at the start of the webinar. Yeah, we're one of the fastest growing law firms in the UK with more than 1,000 lawyers now across 18 offices nationwide. So national coverage, but we've kept our local knowledge everywhere that we act. I've been doing deals for over 20 years now, all types of corporate transactions. So acquisitions, disposals, MBOs, MBIs, VIMBOs, as Joe has mentioned, FAMBOs, which is family and management buyouts. There've even been a couple of BIMBOs along the way. That's buy-in, management buyout, just in case you were wondering. Next slide, please, Rachel. Yeah, so I think before we even get to the actual point of selling your business, I'd like to talk about what we do to get the business ready for sale, because I think this has been mentioned, I think, by all of the speakers so far. This is important, and I absolutely would agree with that. And forgive me if I repeat what some of the other people have said. You know, what we're trying to address here are the potential concerns your buyer might have in connection with your business. So that might revolve, for example, around your customers and suppliers. And by that I mean, are we certain as to the terms upon which you contract with your customers and suppliers? And are those terms onerous, or do they expose the buyer to potential risk? What about your employees? Do they all have proper contracts of employment? Have we complied with our obligations under the national minimum wage? Have we accounted properly or calculated holiday pay correctly? Because that's an issue which always comes up on transactions. Do all your employees have the correct authorizations or permits to work in the UK? What about your property? If it's leasehold, is there sufficient length on the lease to give the buyer comfort that he's going to be able to operate the business without having to be involved in negotiations with the landlord straight away? Is there a dilapidations risk? Have you got any disputes with your neighbours? And moving on from there, risk and compliance. So I've seen issues relating to the handling of waste for companies, its environmental impact, pensions, data protection, even the intellectual property. If you're a business which is heavy on IP, do you own it? Do you have certainty of use? Those are the kind of things which a buyer will need to see and be comfortable with. And why is it important? Well, it's important for a number of reasons, really. Firstly, because if a buyer comes along and all these issues have been addressed, it sees a nice, clean company, that gives the buyer huge confidence in terms of what he's buying. And that will help with the negotiations, because it'll mean that the smaller wrinkles, if there are any, will be less material, and the buyer will perhaps take more of a view on those. It will also expose you to less risk potentially post-deal, because if there is an issue which comes out in due diligence and the buyer is uncomfortable about it, they may want you to take that risk post-deal. And if we've addressed it beforehand and boxed it off, that may not be an issue. And finally, it'll make it easier for the two businesses to be integrated. Now, if you've got consideration which is based on some future performance, if the buyer hasn't got to get involved in addressing some of these issues post-deal, hopefully that will make it easier for your contingencies in terms of that consideration to be met. Thanks, Rachel. Oh, thank you. I'm always asked the question, how long will it take to do the deal from the point at which the lawyers get instructed? Now, I have seen a disposal. In fact, I was involved in a disposal which took less than a month once, and that was the most painful experience of my life. So I would say that it's very rare for it to be done in anything less than about 3 months. Although I have also been involved in a deal where it took 15 months from the point at which I was instructed to complete it, and that was an acquisition which was equally a nightmare. Now, what triggers that process is getting the heads of terms. We've already talked about, you've heard Joe talk about the heads of terms. So that's a document which will set out the principal terms of the deal. So the price, the structure, your ongoing involvement, and also it will include giving the buyer usually a period of exclusivity, which means that you can't negotiate or entertain any negotiations with anyone else while the buyer is committing to the process of negotiating with you. Once we've got the heads of terms signed, we then move on to due diligence, and this will look at all aspects of the business: legal, so that'll be assets, contracts, liabilities, risk, financial, historic performance, what the future might look like, and commercial, so your relationships with your customers and suppliers. And we will have an extensive questionnaire from the buyer, and we will include our responses or prepare our responses and upload them to a data room these days, rather than hard copy in a folder and sent through the post. So this is an online portal which we will be able to monitor access to. We invite a limited number of individuals, and we can see what they're seeing, when they're seeing it, and how long they're spending time looking at it. So it's helpful for us and indeed for the buyer, because it gives the buyer a degree of flexibility. Now, I'm also often asked, how should we respond to these questions? My advice always is, be as comprehensive as you possibly can in terms of your replies. Now, that's subject to a couple of caveats. And the first one is, if you are selling to potentially a competitor or someone else in your industry, and you have price sensitive or customer sensitive information, we may want to either hold that back or redact it. Or if you've got sensitive intellectual property, for example, and you don't want that to be provided to the buyer because it is so important and strategic, then we may also hold that back. I did a deal about 3 or 4 years ago where we didn't let the buyer see the nuts and bolts of our IP at all before completion. And we said, no, you can have it at completion, but you can do due diligence on it, but we don't want you to see it. So a third party looked at the IP only under terms of a confidentiality agreement with us. But other than those particular circumstances, I would advise you to be absolutely transparent, get all the information out there, because again, that is all part and parcel of maintaining that confidence on the part of the buyer. And as I'll come on to explain in a minute, if we've told the buyer stuff in relation to our business, which might be an issue, then we have a good chance of ensuring that the buyer can't proceed against us for recovery of any of the consideration after the event. Thanks, Rachel. So once we've done due diligence, we can then expect to see a share purchase agreement, which is a significant document, usually somewhere between 70 and 150 pages long, split into, generally speaking, split into 2 parts. Front end, which will set out the terms of the deal, so the price, how it will be adjusted if it's going to be adjusted, how it will be paid, any specific protection which the buyer is taking from you, for example, by way of indemnity, your restrictive covenant. And then we have the schedules, which largely are factual, so details of the sellers, details of the companies, what we have to do at completion from a practical point of view, but will also include the buyer protection provisions. And those generally consist of a tax covenant, which is an obligation on us to pay to the buyer any tax which relates to a period prior to completion and which hasn't been provided for or paid, and a set of warranties. Now, I think we've already heard mention of warranties on the webinar already. Now, these warranties aren't a kind of warranty for a defective product. A warranty in a share purchase agreement, in its simplest terms, is a provision, the breach of which gives rise to a right on the part of the innocent party to claim damages. And you will be asked to make a number of statements about the business, all aspects of its history, its assets, its employees, its property, its contracts, intellectual property, and so on. If one of those statements is incorrect at completion, and we haven't told the buyer that, then he has the right to bring a claim for damages based on the difference between what he has paid and what he would have paid had he known about that breach. So it's really important, and this is where the disclosure letter comes in, it's really important that we spend as much time as we can ensuring that we have told the buyer absolutely anything which could be inconsistent with those warranties. Because if it's in the disclosure letter, the buyer's taken to be aware of it, and he cannot bring a claim against you for breach of that warranty. Finally, the last document, consultancy and service agreement. So this reflects the ongoing arrangements that you may have post-completion for your engagement with the business afterwards. Thanks, Rachel. So the next point is ancillary documents. Now, lawyers get really excited about this. And nobody else does. We don't really understand why not. In fact, everyone asks me, why are we signing all these documents? And the simple reason we sign these documents is because what we need to do is to ensure that after the deal, no one can come along and challenge the validity of what we've done. So while they're not very exciting and they're not very interesting, they are, I'm afraid, necessary. And so that includes board minutes for both companies, stock transfer forms, resignation letters. The list, I've only put 3 on there. The list is as long as your arm, really, and it's a kind of paper chase that the lawyers have to do, I'm afraid, and everyone has to be patient with us. Now, in terms of the completion process, once everything's been agreed, these days set piece completion meetings going long into the night, they tend to be a thing of the past. And in fact, completion meetings tend to be much sort of further and fewer between, really, than they used to be. And generally speaking, what happens once the documents are agreed, one side will sign the documents with their lawyer, the other side will sign the documents with their lawyer, and then they will be exchanged electronically, and then completion will just be by way of a telephone call between the parties' lawyers. And in fact, these days, even wet ink signatures on transaction documents are becoming increasingly uncommon, because we're now, particularly through COVID, we're now relying on online signing platforms like DocuSign, which is great because they're very flexible, and it helps with if vendors are in all 4 corners of the country. Thanks, Rachel. So my last slide, this is ahead of this other considerations and sale wrinkles. So some of these, I hope at least, will be dealt with as part of that process of grooming the business for sale before we get to the point where the buyer becomes involved. But if we haven't, these are the kind of issues which can delay a transaction, or worse still, can put a transaction at risk entirely. So, for example, has the target company borrowed money from a bank for which it's given security? Well, then we will need to ensure that security is removed at completion and the bank debt settled. And that's just a logistical process which we will need to factor into the timetable to make sure that doesn't cause a delay. Do you know where your statutory books are? Well, they're important. Lots of people have forgotten where they are. Lots of people have lost them. We can reconstitute them, but they are important because the buyer requires them, because they are prima facie evidence of who the shareholders of the company are. So they need to be written up to the date of completion. Absent shareholders, now this is less of an issue now than it used to be, because we have DocuSign to enable us to get people anywhere in the world to sign documents, and if necessary we can put powers of attorney in place, but we just need to have that in mind to make sure that we don't lose sight of the fact that there'll be some arrangements we need to put in place. Finally, and this is a critical one, has the business been involved in antecedent transactions involving its share capital? If so, do we have the documents for those, and have they been done correctly? Because on many occasions we see a transaction which has taken place and it has not been done correctly, and that's caused untold issues so far as the buyer is concerned. In fact, Poonam and I had one only about 3 or 4 months ago where it caused horrendous delay in the transaction and meant that the seller had to undertake a significant additional liability simply to tidy up what should have been done properly before, unfortunately. The last 3 points, they really all link really to a certain extent. So confidentiality, obviously we need to ensure that we keep this critical information in a very, very tight group, because if it leaks, that can be horrendously unsettling for staff and for customers and for suppliers. Yeah, I'd echo exactly what Joe said earlier, that your project team is really critical here, because selling a business, you only do it once. You need to make sure you get the best outcome you possibly can. It's very stressful, it's very demanding, and you have got a business that you've got to keep on the straight and narrow and keep running as well at the same time. So, you know, if you need a set of advisors who you can trust, who you know can work well together, and who you can rely upon to take some of that burden off you, so that you can ensure that you can keep all the other plates spinning that you need to. And that really leads on to deal fatigue. Yeah, I'm sure that Joe, Poonam, and I've seen this on countless occasions, where sellers are just exhausted by the process and end up almost compromising on issues that perhaps if they had more time to think about it and weren't as exhausted, they wouldn't have compromised, because they just want to get the deal done. Now, our role as your lawyer, and Poonam and Joe's role as your lead advisor, is to make sure you don't compromise on issues that expose you to unnecessary risk. Thank you for listening.